Venture Deals by Feld and Mendelson. Picture this. It's 1957. The world is buzzing with the dawn of the space age, but personal computers? Pure science fiction. Two brilliant engineers, Ken Olsen and Harlan Anderson, have this wild idea to build smaller, more interactive computers. They pitch everywhere, but investors keep shutting them down. Computers? They scoff. Even IBM is barely making money in that game. Just when hope is fading, they meet George Dorio, one of the original venture capitalists. He sees something special. After a few conversations, he sends them a letter offering $70,000 for their little startup, Digital Equipment Corporation. The catch? He wants 78% of the company. Imagine that moment. You've been rejected by everyone. This is your only lifeline, but it costs almost everything. They took the deal. Fast forward 11 years to 1968. DEC goes public and that $70,000 bet. It's now worth over $355 million, a return of more than 5,000 times. It became one of venture capital's legendary home runs. That simple letter from Dorio was the grandfather of what we now call a term sheet. But today's version isn't a friendly one-pager. It's a dense, jargon-filled document loaded with mysterious phrases like liquidation preference, anti-dilution, and protective provisions. It's written in a secret language designed to protect investors, and if you don't understand it, you could lose control of your dream without even realizing what happened. For decades, this world stayed shrouded in mystery. Then two venture capitalists, Feld and Mendelson, did something radical. They wrote the playbook. They pulled back the curtain and explained every term, every tactic, every hidden motivation. They called it Venture Deals, with the bold subtitle, Be Smarter Than Your Lawyer and Venture Capitalist. That's our mission today. Over the next while, we're diving into the wisdom packed in this incredible book. This isn't just for future founders of the next unicorn startup. This is for anyone curious about how big ideas get funded, how power gets structured, and how the high-stakes game of business really works. By the end, you won't just understand the words on a term sheet. You'll grasp the deeper human dynamics of economics and control that shape our world. So let's step into the heart of the deal. Before we can play the game, we need to meet the players. The world of venture deals isn't a simple two-person dance between entrepreneur and investor. It's a crowded floor, and knowing who's who keeps you from getting trampled. At the center stands the entrepreneur, the founder, the dreamer. As the authors remind us, without the entrepreneur, there's no term sheet, no startup ecosystem, nothing. If that's you, you're the star of this show. And you can't outsource the performance to your lawyer. You need to be in the driver's seat. Because this isn't just a transaction. It's the beginning of a long, often challenging relationship. Next up, the venture capitalist, or VC. They've got the money, but they come in different flavors. Think of a VC firm like a pyramid. At the top sit the managing directors or general partners. They're the decision makers, the ones who'll sit on your board and hold real power. Below them are principals or directors. Climbing the ladder, they can champion your deal, but almost always need a general partner's approval. Then there are associates, often brilliant recent grads who do initial research and analysis. They're scouts, not generals. Your job? Figure out who you're actually talking to. Best way? Talk to other entrepreneurs who've worked with that firm. They'll give you the unfiltered truth. Then there's the angel investor, often successful entrepreneurs themselves or wealthy individuals investing their own money in the earliest stages. They're critical to the ecosystem, providing that first crucial seed capital. But not all angels are created equal. Some are incredible mentors. Others might be less sophisticated and create headaches later. The authors offer gold here. If you have lots of small investors like friends and family, group them into a single entity. Chasing 75 different signatures when you're trying to close a deal is a nightmare worth avoiding. When all these investors come together, they form a syndicate. And usually, there's a lead investor, the VC who takes charge, negotiates terms, and rallies the others. As the entrepreneur, finding that lead is your mission. Finally, there are the lawyers. A great lawyer is invaluable. A bad one is a disaster. A great lawyer helps you focus on what matters, while a bad one fights over trivial details, inflates the bill, and creates tension in a relationship that needs trust. Never, ever let your cousin who handles divorces manage your venture financing. So you've got your idea, maybe a small team. Now begins the quest, raising money. The first rule, borrowing from a wise little green Jedi Master, is do or do not. There is no try. Approach fundraising knowing you'll succeed. If you sound like you're just testing the waters, investors smell that uncertainty from miles away. First, figure out how much you're raising. The authors suggest a simple approach. Skip the complex financial model that'll inevitably be wrong. Instead, think about the money needed to reach your next meaningful milestone. Launching your first product? Hitting a certain user count? Calculate your monthly burn rate, total expenses, and give yourself cushion. If you think 6 months, plan for 12. Things always take longer. And be specific. Don't say 5 to 7 million. Pick a number. You can always raise more if demand is there. Next, prepare your materials. Your arsenal. You need a short, 1 to 3 paragraph business description, your elevator pitch. This forms the core email you'll send for introductions. Then comes the executive summary, 1 to 3 pages, crisp and well written. Your first real chance to make an impression. Tell the story. What problem are you solving? Why is your solution amazing? Why is your team the right one? What's the big vision? Finally, you need a presentation. Your slide deck. The authors make a brilliant point. Form matters. A well-designed, visually appealing deck signals quality, especially for consumer products. Not a designer? Find a friend who is. It pays for itself many times over. But the most powerful tool? A demo, a prototype, something people can touch and experience. The authors say they learn more from a 5-minute demo than a 50-page business plan. It shows you can build, not just talk. How do you find the right VC? Best way is a warm introduction from another entrepreneur who knows both of you. It cuts through the noise. But without that network, do your homework. VCs blog, tweet, and live online. Read what they write. Understand what they care about. Don't send a medical device plan to a software-only VC. It wastes everyone's time and shows you skipped basic research. A great rule from the authors. If you want money, ask for advice. If you want advice, ask for money. As you meet VCs, they'll fall into categories. Some are clearly interested and want to lead. Great. Engage. Some pass. Also great. Move on. The tricky ones are the maybes and slow numbers. The maybe hangs around, waiting to see who else bites. Keep them warm, but don't count on them. The slow no never says no, but never moves forward either. You're pushing a rope. The author's advice. Treat these as a no, and stop wasting energy. Your goal is getting a term sheet, the document laying out proposed investment terms. Once you get one, you enter the most critical phase, negotiation. This brings us to the heart of the book. The authors reveal a secret that simplifies everything. After hundreds of deals, They've realized that in any venture financing, only two things really matter: economics and control. Economics means how the money gets divided, especially when the company sells. Control means who makes the big decisions. Every single clause in that dense term sheet falls into one of these buckets. If an investor fights hard on something that doesn't affect their economics or control, they're likely bluffing or inexperienced. This simple lens, economics and control, is your compass for the entire negotiation. Let's start with economics. Everyone focuses first on price or valuation. When a VC says, "I'll invest $5 million at a $20 million valuation," what do they mean? An entrepreneur might hear $20 million pre-money, the company's worth before investment. After $5 million goes in, it's worth $25 million post-money, and the investor owns 20%. But the VC often means $20 million post-money. Then their $5 million buys 25%. It's a subtle language difference with huge ownership implications. The authors advise clarifying immediately. A simple, confident question like, "Just to be clear, you mean $20 million pre-money, right?" forces clarity and shows you know your stuff. The next valuation trap is the employee option pool, stock reserved for future hires. VCs almost always insist this pool gets created or expanded before their investment as part of pre-money valuation. Back to our example, $20 million pre-money. VCs want a 20% option pool. If that comes from pre-money, your effective valuation just dropped to $16 million, because those options dilute founders, not new investors. Key negotiating point. You can argue for a smaller pool with an actual hiring plan, an option budget showing exactly who you'll hire and their equity needs. But the most important economic term, even more than valuation, is liquidation preference. This determines who gets paid first and how much when a company sells. When VCs invest, they don't buy the common stock founders have. They buy preferred stock with special rights, and liquidation preference is the most powerful. In simplest form, a 1x liquidation preference means if the company sells, investors get their money back, the 1x, before anyone else sees a dime. They invested $5 million, they get the first $5 million from the sale. But it gets complicated. There's a feature called participation. If preferred stock is fully participating, investors get their money back first, then share in remaining proceeds with common stockholders. They double dip. Simple example from the book. AVC invests $5 million for a third of the company. Later it sells for $30 million. With simple 1x preference and no participation, they choose take their $5 million back or convert to common and take their 1/3, which is $10 million. Obviously they take $10 million. Founders get the other $20 million. Everyone's happy. But with 1x participating preference in that same $30 million sale, they first get $5 million back. That leaves $25 million. Then they participate in that remaining $25 million, getting 1/3, about $8.3 million. Total payout, $13.3 million. Founders get only $16.7 million. Participation shifted millions from founders to investor. This is why the authors stress, you can't just look at valuation. A higher valuation with aggressive liquidation preferences often beats a lower valuation with clean, founder-friendly terms. In early days, keep it simple. Argue for non-participating preferred stock. It aligns everyone toward big outcomes. Another key economic term is vesting. When you start a company, you're granted a huge chunk of stock. But you don't own it all on day one. It vests over time, typically 4 years with a 1-year cliff. Leave before your 1-year anniversary, you get nothing. After 1 year, you get 25%. Then the rest vests monthly for 3 years. Entrepreneurs often see this as VC control, and it is, but the authors point out it also protects founders from each other. What if a co-founder leaves after 6 months? Without vesting, they walk away with their entire stake while you do all the work. Vesting ensures equity gets earned through commitment over time. It's a tool for alignment, not just for investors, but for the founding team itself. That's the economics bucket. The price, how the pie gets sliced in an exit, and how ownership is earned over time. Now let's turn to control. Even owning less than 50%, VCs can have huge control through specific term sheet provisions. Most obvious, the board of directors. The board is the ultimate governing body. It hires and fires the CEO, approves budgets, decides major strategic moves. Board composition is one of your most important control negotiations. In early-stage deals, a typical 5-person board might be 2 founders, 2 investors, 1 independent member, both sides agree on. This creates balance where no faction has absolute control. As an entrepreneur, fight to maintain this balance as long as possible. But the most powerful control mechanism is protective provisions, effectively veto rights. A list of actions the company can't take without explicit preferred stockholder approval. The list is usually standard: selling the company, changing preferred stock rights, issuing new senior stock, buying back stock, changing board size, or taking on large debt. An entrepreneur's first reaction might be, "Don't you trust me?" But as the authors explain, it's not about personal trust. It's about good governance and eliminating ambiguity. VCs have fiduciary duty to their own investors, limited partners. And these provisions ensure the fundamental structure of their investment can't change without consent. The key is keeping these reasonable so they don't handcuff your day-to-day operations. Another interesting control term is the drag-along agreement. This lets a majority of one shareholder class, usually investors, force all other shareholders to agree to a company sale. This became common after the dot-com bust, when companies sold for less than total investment. In those situations, founders and employees getting nothing would sometimes block deals. The drag-along prevents that, ensuring if investors holding majority risk decide it's time to sell, everyone goes along for the ride. So you've negotiated economics and control. The term sheet is signed. But to truly master this game, you need to understand what motivates your VC. This is where the book reveals how venture capital funds actually work. A VC firm has 2 primary income sources. First is the management fee. When they raise a fund, say $100 million, they typically take about 2% annually to run their firm. That covers salaries, office space, travel. This fee is guaranteed for the fund's life, usually 10 years, regardless of performance. But the real money, the money driving all behavior, is carried interest or carry. This is their profit share. After a VC firm returns all initial capital to investors, in our example, the first $100 million, they typically keep 20% of all profits above that. Say that $100 million fund becomes worth $300 million. The first $100 million returns to investors. That leaves $200 million profit. VCs get 20%, $40 million. The other $160 million goes to their investors. This is key. A 2x or 3x return doesn't move the needle for them. They're hunting for 10x, 50x, or even 100x returns, because those deals generate massive profits and massive carry. This is why VCs often push companies to go big or go home. They're not incentivized by small, safe outcomes. They're incentivized by home runs. Understanding this is crucial. When a VC gives advice, see it through the lens of their financial model. There's another factor: time. A VC fund has limited lifespan, usually 10 to 12 years. They have a commitment period of about 5 years for new investments. After that, only follow-on investments in existing companies. This creates pressure. A VC who invested in year 5 needs liquidity within the next 5 to 7 years. This can sometimes conflict with an entrepreneur's longer-term vision. It's not malicious. Their clock is ticking. Knowing all this, the players, process, terms, and motivations, equips you for the final challenge, negotiation itself. The authors offer timeless wisdom here. First, preparation is everything. Know what you want, what you'll concede, and your walk-away point before entering the room. This includes knowing your BATNA, best alternative to a negotiated agreement. Have another term sheet? Can you bootstrap longer? Your power comes from alternatives. Second, recognize this isn't a single-play game. This isn't a one-time transaction with a stranger. It's the beginning of a long-term partnership. Your goal isn't to win the negotiation. It's achieving a fair outcome both sides feel good about, so you can build something great together. Reputation is everything in this small world. The best leverage possible is competition. If you're lucky enough to have multiple VCs interested, orchestrate a process driving them all toward term sheets around the same time. This puts you in a position of immense strength. But the authors caution: never lie or overplay your hand. Get caught, and you'll lose all credibility. Finally, the book touches on the other term sheet an entrepreneur might encounter, the letter of intent, or LOI, to acquire your company. This kicks off the sale process, and just like a financing term sheet, it's all about economics and control. Price is rarely just a single number. It might include an escrow, a portion held back for a year or two to cover unforeseen problems. It might include an earn-out, part of the price only paid if the business hits targets after acquisition. And it might include a management retention pool, money specifically to keep you and key team members around. All these affect actual cash you and investors receive. Deal structure matters too. Is it a stock deal, where the buyer acquires your entire company? Or an asset deal, where they only buy parts they want, leaving you with a corporate shell to clean up? The principles are the same. Understand details. Focus on what really matters. And negotiate for fairness. As we step back and survey the entire landscape Brad Feld and Jason Mendelson mapped out in venture deals, one powerful theme emerges, and it's not about money. It's about relationships. At its core, a venture deal isn't just a financial transaction. It's the beginning of a marriage, a long-term, high-stakes partnership between entrepreneurs and investors, bound by shared hope for the future. Like any successful marriage, it requires trust, transparency, and deep alignment of interests. The true genius of this book is demystifying complex legal and financial language so entrepreneurs can focus on what truly matters: finding the right partner. The valuation, liquidation preference, protective provisions. These are tools. They're clauses in the prenuptial agreement. They matter, and you need to understand them for self-protection, but they're not the relationship itself. The book teaches us the best investors aren't just capital sources. They're mentors, connectors, and partners there for you not just on sunny days, but stormy ones too. And you can often tell what kind of partner someone will be by how they negotiate. Do they act like a bully, trying to win every point? Or do they approach it collaboratively, seeking fair win-win outcomes? The negotiation is a preview of what it'll be like sitting with them in board meetings when things get tough. So what can you do with this knowledge today, even if you're years from starting a company? First, start paying attention to the language. Next time you read about a startup raising a Series A round, you'll know what that means. you'll understand the valuation they mention is only part of a bigger story. Just familiarizing yourself with this book's glossary puts you ahead of 99% of aspiring entrepreneurs. Second, start thinking in terms of economics and control. This powerful mental model applies to almost any partnership or agreement in life. Joining a club, starting a project with friends, even taking a job. Ask yourself, what are the economics here? How is value created and distributed? Who has control? Who makes key decisions? Thinking this way brings incredible clarity to any situation. Third, and perhaps most importantly, understand this journey is a marathon, not a sprint. The authors emphasize startup community leaders must have long-term commitment, at least 20 years. This isn't about getting rich quick. It's about building something meaningful and lasting, creating value, solving problems, and contributing to a community of builders and dreamers. That was a deep dive into the core ideas of venture deals by Brad Feld and Jason Mendelson. We've covered a lot, from players on the field to the secret language of term sheets, but honestly, a summary can only take you so far. The real magic happens when you hold the book in your hands. It's in those quiet moments when a particular example or simple phrase clicks and gives you profound clarity. This journey we took today is designed to help you decide if this book is worth your time. If anything we've discussed sparked your curiosity or resonated with your ambition, I encourage you to grab a copy. Reading it isn't just learning, it's an experience that can genuinely change how you see the world of business and your potential place in it. A link to the book is in the description below. Also, if you found this summary valuable and you're excited to explore more incredible books on the Billionaire's Bookshelf, please take a moment to hit that like button and subscribe to the channel. It lets us know we're on the right track and ensures you won't miss our next journey into another life-changing book. Let's keep growing together.